A very good day to you, students. I am Sayyid Zaki Ahmed. I will be your instructor for the lecture. I basically excel in finance. So basically, to understand this lecture, please see this lecture till the last, because these techniques are one of the foundation stones for the coming finance lectures. If you are here for the first time on please subscribe my channel on YouTube and press the bell button to get more advanced lectures in future. Bon voyage. Now, before the start of this lecture, let me tell you about this. This is Financial Number Management Part 4 lecture, and it has capital budgeting techniques shown here, the cash inflows, the cash outflow, the payback period, the average rate of return. They are discussed in detail here. So students, now let's discuss capital budgeting. Capital budgeting is basically a process where normally you assess whether can you buy something in future or not of capital nature. Let me discuss capital nature is the project normally which serves you for more than 1 year. Similarly, normal expenses which are normally taken in the profit and loss accounts, they serve you for 1 year and they are normally cut off during a year whenever it ends, and the next year expenses are taken separately. But with capital budgeting, the process goes on till 4 5 years, because the asset is expensive one and it will serve you for at least more than 1 year, technically speaking. For the examples are basically the construction of a new plant or investment outside a venture for the project. Like if you want to start a new project, a new machine in there, you have to put there, and then you have to assess first the money requirement, the hurdles for running that projects, all have to be assessed before. So capital budgeting is basically assessing beforehand, before starting the project, what it should be and it will be in future if we start the project. Now, is in this capital budgeting process with the companies, normally they assess the prospective project's lifetime, the cash flows we have to put in, and the cash flows that will come out of the project. It has to be project specific, not company specific. Project specific cash inflows, whether it will give you that much money in future, so to add benefit to the company or not. I hope you understand my point. Again, capital budgeting is project specific. It's like you are as an individual buying a car, you cannot straight away go to a shop and buy a car. You have to assess your budgets, everything, your taxi expenditures and everything. So in case you buy this car, how much benefit it will give you in future. So viewers, there are few terms used in capital budgeting. Let's discuss those first before going into the capital budgeting topic. First is initial investment. Normally, whenever you start a project, you have to assess how much initially it will cost to start. So this is your initial, that will include cost of machinery or setup cost, everything that is to start the cost. The expenses are the usual expenses which are normally done whenever the project is running. If they are during the regular cycle, they are deducted from the sales and everything, and we get the cash outflow from the profit also. There are generally two methods of extracting cash flows out of it. Either we take the income statement from the accounts department and take the profit from there and out, make some few adjustments to get the exact cash flow to understand the money inflow or outflow of the project. Now, let's see this cash outflow. Whenever the project is running in a regular sequence in the yearly method, it will operate and make money or make profit or maybe sometime loss also. Normally, the annual income statement is made after every year. So these outflows or cash flows are normally calculated from the profits of the accounts department calculations. Now the terminal cash flows are those when the particular project ends in a certain time. Then the scrap value also will return, the machinery is sold out, scrap fund. Similarly, the stocks also remaining there, they are also sold out. So we receive an extra cash during termination, with the exception of the sale also. Similarly, we have taxes. We know we pay the taxes, and taxes are already deducted from the profit. Now, whenever we are calculating cash flow from profit, these taxes have to be added back to get the exact position how much the project is earning in form of cash. Similarly, depreciation, which is normally extracted out of profit, normally the profit you get is normally with subtraction of depreciation, but depreciation is a non-cash expense. So calculating cash flows, we after getting the profit from the accounts department of the year, we add back that depreciation to get exact value of the cash flow. Now to run the project, we also need raw material in the start, labor also to make the things, everything, and overheads that are particularly required to start production or start a project. This is called the working capital. Normally it is at the start of the project and it is already taken as an expense in the project. And now students, let's discuss cash flows. You can use whatever sign you want. If you want to put minus sign wherever the money is going in the project, you can use that also. And whenever the money is coming out of the project from their income, business income or anything, you can use a positive sign for that. This sign method, you must remember whether the project was using the money or it was paying you the money. That is your own concept basically. So this concept of cash flows must be particularly for that particular project, not the company or not the individual. So whenever the project is seen, as far as the assessment is done, it is done with particular reference to that project, investment, money, and money output from that project. There are a few adjustments which are done normally at the end of normally the period to understand the cash flow. I will show you the later on in the project, and these so you can understand the inflows and cash outflows process. Students, now how do we calculate our cash flows? There are different methods available. The best place is the accounting office where we can get the all cash outflows in a project and cash inflows of a project. So we can use that information for detailed study. But the easiest way for the finance people is to get a profit and loss statement. As we know that profit and loss statement contains sale, fixed expenses, variable expenses, depreciation, and tax. So when we do this plus minus, we get profit. Or in a simplest way, we write the formula again. Sale minus FC minus VC minus depreciation minus tax is equal to profit. So this profit will, when given to the finance people, making a few adjustments, we can get the exact cash inflow or outflow net from the project. Now let's start with the capital budgeting techniques we have. The first one is the payback period, although this is not a very superb evaluation technique, but we have to study in finance. For that, the best thing would be we study an example. Let's say we have $10,000 in our hand, and in this $10,000, you can start 3 or 4 projects available with you. They are shown in the next slide also. Now, now you compare these slides with their money coming out of it and their investment. Each project takes 10,000, and you can invest in one project. So technically, let's see the next slide and you can understand how do we assess the payback period. Now students, let's study the payback period. Payback period is the reference to the amount of time taken by the project to recover the investment done on it. In the most simplest word, the payback period is the length of time an investment reaches a break-even point or your initial investment is fully recovered. So for that, the examples is given below. Let me get my pointer to give you a full proper understanding. Now this is the pointer here. We have 4 projects A, B, C, D. The yellow ones are cash returns every year 1, 2, 3, 4. Similarly here also. And this is the initial investment with a minus sign here shown here. You see 10,000 is available with you. You can use only one project money for one project, and so we start calculating. Now you see the total comes here. You see the total income here is 12,000, 16,000, 16,000 and 15,000. Now we calculate the amount of time to recover this initial investment on each project. Now with 3,000, we have this 3 years and 0.33 3.33 years to recover your initial investment. Similarly, here we have 2.5 years with these returns coming in. You see, similarly here also we have 4 years time. In the third D project, we have 2 years time to recover this. So, ranking wise, with this payback period wise, we have number 1 standing for project D, number 2 standing for project B, and so on. I hope you understand the payback period now. Now students, the types of capital budgeting techniques. The first one, that is the basic one I'm going to discuss, is the average rate of return. Average rate of return refers to the percentage of average returns divided by the average investment of a project. This is expressed in percentage. So the formula is given here: average annual net earnings after taxes divided by initial investment multiplied by 100. Let me take my pointer out. Yeah, now this is the pointer here. If we study this example, this is an example of basically the average return, how to calculate that. Let's assume that a company generates profits or returns 25,000 in year 1 and 30,000 in year 2, and similarly 35,000 in year 3. The initial investment given here is 350,000 with a salvage or scrap value of 50,000. The estimated life of 3 years. So how do we calculate the average rate of return on the investment based on the given information? Now in the formula we have average return after tax divided by average investment multiplied by 100. Now you see the average return is 25,000, 30,000, and 35,000 for 3 years. Average would be divided by 3 years. That would be 10,000 on the average return. Similarly, average investment, we have 350,000. We subtract the scrap value because this value will be returned back. So the actual investment was 350,000 minus your scrap value, that would be 300,000. So when we divide the two, we get about, in percentage, 10%. So you understand the point now. Now consider four projects in a line. We have the option of doing one project. How do we assess with the average rate of return valuation? How do we rank these projects? So let's see our four projects. We have initial investment of minus 50,000. I write minus because this is investment going in. 65,000, 75,000, and 70,000. The returns for 3 years would be, for A is this the yellow part, for B again the yellow part, 7,000, 12,000, and 17,000. Similarly, C also has the returns, three returns for 3 years. Similarly, is project D. Now the total is here, returns for 3 years. The average return here is 9,000, 12,000, 10,833, and 11,667. Now the salvage value I is given here, my 5,000, 7,000, 8,000, and 7,000. Now doing the same thing using these salvage value also, we calculate the average return by the same formula given before in the slide. We get 20%, 20.7%, 16.2%, 18.5%. So in the ranking position, number one stands for project B, and the second one stands for project A, and the third is project D, and the last one is 4 for your accounting rate of return valuation of the project. So this is the way we evaluate the projects normally, by keeping side by side the projects and their returns and their value and their accounting average rate of return. My next coming lecture would be financial management lecture number 5, and it will include capital budgeting, net present value, internal rate of return in the coming lecture. So please do visit my site again when I put this lecture in my channel. Now students, I end this my lecture today, and the view, kindly refer my parent channel, that is Mindbenders 172, for more knowledge videos, and subscribe if you are here for the first time. I am going to start a new channel, Lesson Pair, for my lectures and specifically for my educational channel, which will be running in a due course in a few days. Kindly refer to that also if you need some more knowledge items. For all your queries, you may contact my email given here or WhatsApp number.